Hi, this is Dan Miller, Milestone Financial Group. It is Tuesday, March 28th, and I wanted to do a very quick video talking about some of the news out there right now about the bank failures with SVB Bank and Signature Bank. First thing that I want to say is that this is not 2008, 2009 crisis over. You know, what we're seeing here with this, it's very limited to a few banks that are involved in some very speculative type interests. With SVB Bank, of course, it was the tech industry, and with Signature Bank, it was cryptocurrency. And so, you know, this is kind of a result of a lot of things that have happened over the last couple of years with these two particular banks. But just, I'm going to try to put it in a very short video here. With SVB, of course, they had a meteoric rise back during the pandemic because they were financed by a lot of tech startups, or they helped finance a lot of tech startups. And of course, they received millions and millions in assets there that they had to invest. Well, of course, at that time, the only place that you could really find any type of long-term safe return was long-term bond rates. Well, now let's flash forward. What has happened in the last couple of years? We've seen interest rates rise significantly, which, of course, as you are aware, that interest rates and bond values have an adverse relationship. So, you know, as long as bonds are held to maturity, there's not a problem. But in SVB's case, they were forced to sell some of their, a significant amount, over $2 billion, I believe it was, of their bond holdings that they had before they matured, because there was a run on the bank for cash, because some of these tech startups had troubles and for other various reasons. Well, because of that, they created a situation where they had to liquidate investments that they held in long-term treasuries at a significant loss. And because of that, they became insolvent. So it is a very specific thing that happened to this bank. And one of the things that you know, I guess I would point out is, you know, compared to 2008 and 2009, you know, the banking system is in much better shape than it was back then. You know, it's very well capitalized as a whole. Now, does that not mean that there are other banks that probably have, or no, not probably, that do have some of these other, or that have some of these same type of investments on their books? Of course they do. But again, as long as there's not a run on the bank and they're held to maturity, there's really not a problem there. Okay. Yes, new bonds are issued at higher rates, but the ones that they have on their books now, if they're not forced to sell them, there's not any problem. So there is some contagion fear here. Again, just whenever you hear about it, and of course it's blown up in the media. Not that it's not important. I don't mean to downplay that at all. It is big news. But again, there are a lot of more checks and balances in place to protect the banking system as a whole. And remember, there is FDIC insurance, and that's one of the things that was a significant difference out there. Is I believe I read where only 9% of their deposits were covered by FDIC, meaning that only the 91% of their deposits were more than $250,000 per account. Now, and in the case of Signature Bank and SVB, the FDIC did use some special authority to come in and guarantee all of those holdings, or all of those deposits. So as it looks right now, there's no depositors in those two banks going to lose any value. So again, and since that time till now, the FDIC, of course, has been holding those bank assets, and they're beginning to be sold off into different aspects. So again, if you have questions or concerns about this, you know, please feel free to reach out to us here at Milestone Financial Group. We're more than willing to help you however we can, answer any questions. Hopefully this has been helpful. And again, there's information out there available that we'd be happy to provide for you if you have more questions. Thank you very much. Have a great day.